Welcome to the daily update. This is being prepared Friday, August 19th, where we'll look at the action in the market today and then see how things look for Monday, August 22nd. And this will be a full-length video. As much as I enjoy doing them, it is nice to kind of take some time away from that. And I just mostly posted the daily briefs. And so far, it's about 50-50. Some of you like to watch the shorter videos during the week and then maybe some longer videos on the weekend. Others, you like to watch the long video each day, and I understand that. My intentions are to do both each day, but there will be times when I'm not able to do both, and I'll at least try to do the daily brief each day, and then I'll let you know if that will not be the case, especially if I know that beforehand. So let's go back and talk about what happened on Friday. At the open, we didn't have any economic reports, and the market just wanted to go lower. We've been short-term overbought, even some intermediate-term overbought. Well, that kind of got worked off on Friday. In fact, it's turned some of our indicators a little bit more negative than what we would like, but we'll have to see how things go with that, and I'll show you the charts. We gapped lower right at the open. We went right down below S1 at 42.66. We even dropped below S2 at 42.49. And because Thursday's session was not all that radical as far as price movement, I even had to break out and calculate S3 at 42.17. We chopped below S2 and then went all the way down to S3. Going into the close, we had a slight bounce up off of that, off the worst levels. We ended up being down 1.29%. Volume was below average, but it was up. It was an options expiration day, which we usually see a real increase in volume on that day, but we were still below average overall. The technicals are positive, but we're seeing some signs of weakness and shifting. And this is what interests me about this. When we're going up and I watch other people's videos, or I don't really watch the financial media, but they just flippantly throw out these statements like, yeah, we're going up. We might go back and test the June lows or test this low or test that low. And then we actually do that and we get down to near that level, and then everything has changed at that point. So I tend to, when somebody says we're going to retest this, retest that, yeah, we may end up doing it, but I don't really take that at their word, especially with the difficulties that we've had in 2022. When we go down to retest something, we've just been going below that even. So I don't really say that a lot in my videos. I talk about tests and retests and so forth, but only when they're happening. I don't just flippantly throw it out there and say, oh, don't worry about it, we might go back down. Well, when we do go down, the whole environment may have changed at that point. But we're still positive overall, but there are some things that we just want to be aware of. Inflation and interest rates, that's the big focus right now with the geopolitical concerns, the whole list of those things, not necessarily impacting the markets, but could at any time. We have earnings that are coming out, and then this whole debate back and forth about what is a recession and are we in one? So what are some comments? We did have options expiration on this past Friday. Kind of what set the negative tone is the biggest economy in the EU is Germany. And so we want to keep an eye on what's going on in Germany from an economic standpoint, because if they're having trouble, sometimes they're like a leading indicator for us. So their PPI was much stronger than expected, where our PPI actually was more market friendly, and we were able to at least put in a positive week after ours came out. Well, that didn't happen in Germany. So they're having a lot more inflation concerns. And they've also predicted that their recession will likely last longer than what's being predicted in the US. The sector rotation and our positive setups, yeah, they're still positive, and we're still using them as setups, and we're still working off of those, but they're showing a bit of weakness, especially after Friday's move. And then we've seen this retreat ever since last Tuesday when we went up, we touched close to the 200-day simple moving average, and we've been pulling back ever since. Now, some of the other indexes, they were able to get a little bit above that, not the NASDAQ or the NASDAQ 100, but this will really be a test for the S&P because it's considered to be the broadest measure of the US stock market. And if it can get above its 200-day moving average, that would be quite positive. And that just has not happened yet. We still have the 10-year to the 2-year and the 10 to the 5-year. Both of those yield curves remain inverted. We're back to more of a neutral reading in our fear and greed index. We didn't have any economic reports coming out. And our trend is still positive overall with the ADX above 20. I've switched the bias over to negative because Friday's downward action was a little bit more negative than what we would like to see right now. Now, we can recover from that, and maybe it was overdone, and maybe it had to do with options expiration. But based on what we're seeing right now, a bit of a pullback is nice, but it was a little bit more intense from what I was watching. And I switched our momentum back to mixed as well. So let's go back and talk about the day's session. Here we are at 51. So we're at neutral, where we're still right at the midpoint. We're not showing excessive fear or greed at this time. We did get the AAII report coming out where we still have individual investors. They're showing an improvement in their sentiment, but they're still negative overall. We had the most recent Ridex bear bull ratio, shows that it's coming down a little bit, which means people are getting more into the bullish funds than they are the bearish funds. But this came out before Friday's downward move, so you might see some reaction to that. Here is just showing how we're seeing some weakness right now in the real estate market. A lot of the reports coming out have been declining, and we're seeing prices starting to come down. We're seeing interest rates going up, and it's a lot harder for folks to get mortgages or to refinance. And so this just measures the privately owned housing units that are authorized in permit issuing places. And other times when this has topped out and gone down, that has suggested a real weakness in the overall housing market. Well, has it topped out now? And is it starting to go down? And incidentally, I do have some IsabelNet charts. Not all of them are from Friday, but I weeded a lot of them out because I would just spend all my time going through those. Another thing that is kind of interesting is at the end of summer, end of rally. It happens almost every year. This goes back to 1928. And right in here in August, this shows that we have an upward August, but then September has historically not been a well-performing month. Now, there's other studies I've looked at that say September's been a good month. See, if you go back to 1927, if you go to 1932, if you go to 1948, you're going to get different results in these charts. But again, we're coming into that time of year, September, October, where sometimes the markets have had real trouble during that time. Other times they've not had any trouble. All right. This is the S&P 500 and then bear market rallies. Now, some people have the idea that we are in a bear market right now, and that what we're seeing is just a dead cat bounce before we get set to go lower. There's other people that say, no. We're in a secular bull market that's longer term, and that can go on for years and years and even a decade or longer. And what we're seeing so far in 2022 is just a cyclical bear market within a bigger picture bull market. And really, you'll only know the answer to this in hindsight. People can go back and forth and argue this and that and everything else. We won't know this until we can look back in the future and go, oh, that's what was happening then. We just kind of have to guess right now. But this just shows that if we are in a bear market, and to see a 15% bounce is not necessarily all that strange. A lot of times when there have been bounces within bear markets, we've seen really nice bounces coming up out of that, even stronger than what we've seen right now. But again, that's kind of up to debate. This also suggests the PMI it's showing a lot of weakness ahead of in the headline survey, where the blue line is the ISM headline number, and it's been declining. And then this is the ISM manufacturing PMI with new orders, less inventory spread. And I've talked a little bit about that. When a company makes a product and they can't sell it, it has to sit on their own shelves. That's inventory. They want to get that out the door so that they can produce more of whatever they're producing. Well, we're also starting to see new orders decrease as inventories are starting to increase. We're seeing new orders decrease as the inventories are increasing overall. And that could suggest some economic slowdown. Then the global profit optimism also easing from a record low. This might suggest that we possibly have hit a bottom and are starting to come up out of that, because at other times when we hit a bottom, those usually marked a significant low in the market. This is just showing that most people are still in cash as of August. That's the dark blue line up here, where people are switching out of commodities quite a bit. We're seeing more cash. The FANG stocks, some people are starting to get back into them because they're getting back into the tech trades. They're not as short in treasuries, and they're getting a little bit short in their emerging markets debt. And this is just showing the gradual shift from month to month. This is just saying for good for whom? Now, remember, in America's history, in the 1800s or so, we were a goods-oriented economy. We would make things, and we did that even into the 1900s. But then there's been this shift from being more of a goods-oriented economy into and I have to clear my throat, into being more of services oriented, where we're not actually making products, we're just doing things and supporting other companies that do make products. And this just shows the S&P 500 earnings. For goods, it's about 62% of the index. Services is about 38%. And then according to GDP, it's about 32% are goods that are produced. But now we've seen the real jump from an agricultural society into a service-oriented society, and that's 59%. And then this other, I'm not quite sure what other is, but maybe who knows? Use your imagination with that one. This is also talking about how are people feeling. They're mostly concerned about inflation, that it's going to stay high. And that's what we're showing for August. It's about the same amount of folks that think we're going to have a global recession, not just within the US, but globally. A little bit of a decrease with the folks they're starting to have this scenario. Are they going to start lowering interest rates or get more dovish if inflation is starting to come down? Systematic credit events, not really worried about that. These are meltdowns in banks or even run on banks. Not really worried about COVID-19. And look at the Russia-Ukraine conflict. It's like not really in the news in the US these days. It's still going on and people are still getting hurt. And it's kind of shifted now to where Ukraine isn't seeing as much of an advantage as they seem to be before. But you're not hearing an awful lot about that. And so people tend to forget. Well, if something tends to happen, this is one of our geopolitical concerns, and this could come to the forefront and freak out the market, either in a good way or in a bad way. But people aren't really focused on that right now. This also says that inflation is still the main thing that people are worried about. They think that they're going to lower interest rates if the PCE deflator drops below 4%, a little bit less in August than they saw in July. We're looking at the employment situation report. If the S&P starts to fall, the high yield bond spreads, that's the risky versus unrisky spreads. Still a little bit of concern there, and they're not all that concerned if oil drops below 90. Really, the only one that we've hit briefly is the bottom one. Oil did drop below 90 for a while, but now it's back above. Then we had the active asset managers survey come out. It declined in the latest reading. It actually gone up a little bit, but since pulled off. Still pretty much more neutral, not really giving us an extreme reading either way. This is the screenshot after Friday's close, where we saw growth really underperform value with the large caps, mid caps, and about even with the small caps. The VIX, after really dropping below 20, which is considered to be more complacent, really it's when it gets down to 12, but you have to look at this on a relative basis. We've been chopping sideways with the VIX. Not a lot of fear had been coming in. Well, with Friday's decline, some fear started to come back in to the market. The VIX of the VIX also is showing just a little bit more of volatility right now. The daily ulcer index not helping. The weekly chart is still more indicative about where we're at as far as kind of right in between fear and greed. We're down 12.25% from the all-time high. Here's the equity put call ratio. It had been coming down, but over the last few days saw a little move up, where the 5-period simple moving average had been declining, but then as starting to turn back up. Here are the pivot levels for Monday's session. And here's the daily chart where we had come all the way up to the 200-day moving average, which is very close to this trend line. And we saw them kind of converging with each other. We came up, we touched that, and now we've been bouncing back down, and we actually dropped below R1. Down at the bottom, you can see where there was an increase in volume, but it's still below average. And looking at this blue line here, you can see the average itself is starting to go down slightly. Here are the pivot points for the whole month of August with the updated candlesticks on the chart, showing the Fibonacci retracement going from the low set in 2021 to the all-time high. We had bounced back up. We'd got back up above the 61.8 and the 50% retracement. Well, now we're starting to drop back down below that. This is going back to the COVID low to the all-time high, where we were able to get slightly above this 38.2% retracement level, but now we're starting to drop back down. And can these other areas that we broke through, can they provide some support if prices continue to fall? Our sectors, and I have some different charts that I want to show you here in a moment, where discretionary was down the most at over 2%. Financials got hit. There was really only one sector that was up, and that was healthcare in Friday's session. Here are the technical analysis scooter scores, where you still have utilities and energy, followed by staples, looking pretty good, and industrials also came into the low 90s, with the communication still showing a lot of weakness. This is going back to the all-time high. Energy and utilities are positive. Staples are just barely positive, but all of the other sectors are negative, with communication still being in last place. This is looking at the indexes from the all-time high, the NASDAQ 100. The Dow has been holding up the best. Here in pink is the S&P 500. Technical alerts, none for the S&P, a lot for the NASDAQ and some of our sectors, where we had a BPI cross below in the financial sector and it was down. The NASDAQ went below 12.9, 12.8, 12.7. The cyclicals, they crossed below 80, and the NASDAQ had a cross below 50. So we're seeing a little bit more negativity with our technical alerts. Now, this is a new section. I just want to see if you find this helpful, where I go in and I just look at, I'm looking at ETFs, but the diamonds, they apply to the Dow. And this rates the scooter score for the Dow, and it's currently at 84.1, and it's number one. I'm going to try to arrange these. I have 5 or 6 charts to show you, and I'm going to go in descending order with the best looking one first. The thing that can make this a little bit helpful is we get a bit of historical score with this chart, just to show us how the Dow has been improving overall on a technical basis. Here's the mid caps, also at 81.1. It also has been showing some improvement, although it declined a bit in Friday's session. These are small caps, also showing some improvement, but a little bit of recent weakness. Then now we have the SPY, which is the ETF for the S&P 500. It has a score of 75, also showing some improvement. The Qs, they were not doing as well, but they've been really hoping to help this rotation back into growth. But overall, they still have a lot more damage to repair, and we've been seeing some recent weakness. So let me know what you think of those charts. I wish I could put them all on one screen, but my gosh, there would be so many charts there that I don't even know if you could see it. All right, intraday. We gapped lower, went through S1, down through S2. Then we kind of meandered our way down here to S3, which is, I don't know why this isn't on here. I actually put S3 on this chart. So, okay, but right down here at the low, that ended up being the low for the session, was S3. And then we did bounce up off of that slightly. Looking at our trend, we are seeing the green line coming down and the red line coming up, but the ADX is rolling over a bit, but it's still above 20, still above the moving average, but showing some potential weakness. The Arun also showing a decrease in buying. We're flattening out a bit with the selling. So our oscillator is actually turning down a little bit, but it's still above zero. So that means it's positive. Advanced decline based on price and volume has been doing pretty well, but seeing some recent weakness. Advanced decline ratio, it had gone extreme positive and has now worked that off. New highs and new lows, they're holding up for right now, but we want to keep an eye on this because if they really start to roll over, that will turn things a bit more negative. Accumulation distribution, also some recent weakness, but still above an advancing moving average. Short term, we came right up to the 200-day and we're bouncing back down below that. As long as we stay above these other moving averages, it will help them to continue to turn up and possibly help this chart to look more positive as we go forward. Stochc RSI had been extreme positive and boom, just shot down to extreme negative. Williams percent R also working off more of an extreme positive reading. The force index also saw a decline, but is still positive overall. The Swinland trading oscillator, it is also coming down after giving us an extreme positive reading, but it's still above zero, but it's pointed down right now. McClellan oscillator also has worked off this extreme positive reading, and it's still above zero for right now anyway. The 20-period exponential moving average study crossing back down, 50, starting to cross below. The 200 has started to roll back over. Stochastics, working off the short, intermediate term signals and rolling over a bit with the longer term stochastic. Intermediate term chart, after giving us a real extreme positive reading with the 19-day exponential moving average of the advanced decline line, it has now come back down and is no longer extreme. The Sean trend meter starting to turn down. The PMO holding up, but starting to roll over a bit based on price and volume. The PMOs that are rising after going extreme positive, okay, don't know why that advanced, is now, it's still positive, but it's now headed down overall, where we're working off the buy signals and we're still going up with those PMOs above zero. The Chaikin oscillator, it started to kind of show a negative divergence. As the S&P was going up, we started to see some weakness in this oscillator that might be starting to play out now, as is the Chaikin money flow. Still positive, but showing some weakness. Volume, it picked up just a little bit because it was options expiration, but it's still low overall. The Vortex is still positive, but showing some weakness. The summation index based on price, and this line up here, that's kind of an extreme positive reading. So that's more intermediate term overbought, and it hasn't really rolled over yet. The summation index based on volume, it has rolled over and started to turn down. The slope is now looking more negative. The MACD could be crossing over. The KST is rolling over a bit, as is the TRIX, the PMO, and the TSI, but they haven't crossed over yet. The only one that's actually a little bit more negative is slope right now. The BPI, after giving us an extreme positive reading, is still working its way off of that. The ease of movement is showing some recent weakness. Ultimate oscillators headed down, but still above the midpoint. Money flow index, after almost getting extreme, has been pulling back. RSI 14 and 9, after giving us an extreme positive reading, this is now an overbought signal on both of these calculations. The boom indicator was really starting to get extreme, and that's starting to work off. And we're still okay. We're above zero with the 200 period moving average. TTM squeeze. Also, when these turn a little bit darker, that's showing some weakness, even though we're still overall positive. Our different charts, the Heikin Ashi looking a little bit more negative. The Kegi still looking positive, as is the Renko and the 3-line break. No new X's as of Friday's session. We're still going off that triple top breakout with the point and figure chart. Our different systems, we've switched back to neutral with the elders and with the SPY. We're neutral. This is also a little bit concerning. The SAR now has a dot on top. So that is more of a negative signal. Go, no-go system is still looking positive. Long-term charts. These are the long-term moving averages in our rainbow where we'd come up to the moving average and we're starting to come back down now. Our moving average study also looking a little extreme with the 50, turning down with the 150 and 200. The special K kind of flattening out a little bit after it had been trying to improve. We're back to neutral with the diamonds. Here's the Dow where it got above the 200-day moving average, but now crossed below it and also is below R1. The Qs have actually switched over to negative right now. And here's the NASDAQ 100. Never got up to its 100-day, but is now dropped below R1 as a pivot level. The Vixen shot up a little bit, but not all that much. The market was getting a bit complacent. The NASDAQ never did get to its 200-day moving average, but has been retreating and now below R1. The mid caps did get above their moving average, but have now dropped below. The Wilshire never got to the moving average and has dropped below R1. The dollar, it had been showing some weakness overall, but with some of the weakness that we've seen in stocks, the dollar has bounced back quite a bit. And we're pretty much neutral with the S&P to the dollar right now. And a lot of our correlations are neutral right now. The market's a little confused. It might be getting ready to shift. It might be trying to work off this short and intermediate term overbought situation before we do get set to go higher. At least that's one scenario. Or we're looking at a rebalancing and a shifting before the market's getting set to go lower. Gold, after having kind of a nice bounce, has since been really suffering. The same with silver, also still in a downtrend. Oil is right at 90 at 90.44. The correlation is still pretty much neutral, but kind of dropped down a little bit to going in the opposite direction. Bonds, they've seen some recent weakness based on price because interest rates have been going back up. Here's our world bond index. It had been showing a nice little bounce. Well, it's starting to come back down. The stock to bond correlation is neutral right now. And our yield curves, we still have the 10 to the 5 is negative. The 10 to the 2 is negative. We have not gone negative with the 10 to the 3 month, but it's still ever so close. The tech to the 10-year, neutral again. And this is another fib retracement that I posted a while back. This was the high that we set back at the beginning of the year, the all-time high, and then the low that we set in June. We were able to retrace more than 50% of that. Well, now we're dropping down right to the 50% retracement. So we're kind of on the fence right now. The 30-year yield, which had been coming down, is now starting to go back up, and it's at 3.22%. And here's our yields where it's just bumper cars all over the place. But mostly we had been seeing an overall decline in yields. Now we're starting to see more of an advance in yields. Our scenarios, this is still viable with the stocks above their 200-day simple moving average. The stocks that are above their 50 after going extreme has worked that off a little bit. Same thing with the mid caps. Although we didn't go extreme, this is still a valid signal, as is with the small caps. The 10-day average of the highs and lows, that's still holding up fairly well right now. And the broad market look at the 5-period moving average of the highs minus lows, that's still holding up. The equity put call ratio after spiking up is still continuing to fall, even though it's bouncing back up slightly with the recent weakness. Small caps, they were able to get above the 200-day moving average, but have then fallen back below. Here's the ratio. They're kind of chopping sideways right now. So after spiking up, they're starting to fall back down. And that kind of is showing a little bit of recent weakness in the S&P 500. The S&P to the 10-year is kind of working back more towards neutral right now with their correlation. Our sector rotation, the moving averages are still going up, but we're seeing some weakness with the Qs. Discretionary is falling a bit. Large cap growth versus value has also been declining. Doesn't mean it can't recover from here, but if this really starts to turn, then we might have to adjust our view on things. Here's the large, mid, and small caps where we're seeing some weakness now, dropping below the moving average, but the moving average is still going higher. The correlation between the S&P and the 2-year is neutral right now, so we don't know if this is a valid spike or not. So this signal is not necessarily that strong. The staples were down a bit, but they've been showing some recent recovery after giving us that death cross. And so this is still looking like a valid spike. We've been coming down, but now it's been coming back up. So we'll want to keep an eye on that. All right, so what's our outlook then? We're still positive, but Friday's decline was a bit more intense. It was really a lot weaker than what you would hope for. It's actually turned some of our indicators negative and is showing some weakness. Sentiment remains neutral. We don't have any reports coming out on Monday. The whole list of geopolitical concerns with inflation and interest rates being at the top of the list. We can't really go with a down scenario yet, but all of these things that are listed here, if they come to the forefront, that could see some more follow through weakness. The technicals are still positive, but showing some weakness. We're still going with the up scenario, but it looks like it could be stalling, at least right now. It just looks like a pause. But if we see follow through, we might have to change that stance. And there's a real disbelief that the market can go higher. Our scenarios, they're still on the table and looking viable, but we just want to see if we can see some follow through with price action. We're still dealing with that 200-day moving average. That's the biggie. If we even get back up to that, that's the big one for the S&P, and we're not sideways currently. So our conclusion then is the S&P is positive, but it might be starting to weaken. We need Monday or Tuesday to show some buying coming back in for this more positive environment to continue. Short term, we're positive, but could be weakening. Intermediate term might be weakening. Long term, we're still negative. All right, so thank you. Have a wonderful weekend. I will be preparing the daily brief. I'll also be doing the weekly video and the intermarket analysis video as the weekend plays itself out.